We had quite a sharp pullback yesterday, a little bit of a recovery on the markets today. Do you think yesterday's pullback was an overreaction to some of those negative economic reports we've seen coming out?
Stephen, it's a combination of factors that have come in. We saw Alcoa coming out, really setting the tone for the earnings season that started out in the US, and obviously we saw Japan's nuclear disaster really coming to the fore again. So that and muted comments coming out of the IMF in terms of the risk to the global recovery through 2011 and 2012. So those factors really putting a dampener on the markets. We are seeing the markets rebound slightly today, but it's very muted and unlikely at this moment without getting further direction from global markets. It's unlikely to continue at the pace that we saw the pullback from yesterday.
How about volumes? Are we seeing any pickup in volumes? Are investors selling with conviction and buying with conviction, at least at this stage?
Stephen, volume's fairly low. We saw 11 billion traded on Monday and then slightly lower yesterday at 10.5. So investors still possibly buying in the dips. We saw stocks obviously reaching their lows in March. So a few or probably many investors are hoping that yesterday was just a bit of a pullback and are nibbling at stocks today.
Well, with Anglo-American falling 4.5% yesterday, would this be an opportunity for investors to get back into those Anglo shares if they still have a positive midterm view on commodity prices?
Correct, Stephen. Any pullback really, and when we see Anglo's down at 4.6, we also saw Billiton yesterday down 3%, and we obviously saw with Billiton the share buyback really supporting that share price, and we're going to see continued support for Billiton probably through most of the year. That it is probably a good time to buy unless you have a feeling that the global recovery is definitely under threat, and really that inflation is a very huge risk, in which case investors should keep their buying to smaller quantities.
Well, what do you think of those reports from the IMF? We also had the US Fed speaking about growth prospects as well. Do you think what the IMF is painting of the global recovery does put growth at risk and perhaps commodity prices going forward?
See, we do believe that those risks are very real, that inflation is very much a real risk for your poorer countries. Obviously with Brent oil remaining above $120 a barrel, and the higher commodity prices as well as food prices that we're going to see going through the year with the severe weather conditions that we're continuing to see, that it is a real threat for especially emerging countries, and we'll have to see how your China, your India, your Brazil are going to be able to maintain the growth expectations of over 8% approximately across all three countries through 2011.
Let's take a look at the US earnings season. You mentioned Alcoa out with numbers on Monday after the bell. It beat expectations on the profit line, missed expectations on the revenue line. Really the forward-looking statements as well that the market punished that stock for.
Correct, Stephen. Literally, it is. We've seen Alcoa at the start of each of the last three earnings seasons really coming out with really good results and fairly good forecasts. And it's the first time that they've come out to say that growth expectations, they're fairly cautious about growth expectations. So that plus the IMF comments have really put a damper, and we're seeing risk really coming out of the markets today.
Well, we have JP Morgan reporting later on today. What's the market looking for from JP Morgan?
Stephen, they're really looking for. We've seen that US banks have really been able to reward their shareholders with dividends, and they really need to see it in terms of how they're going to manage their debt. All those debts, are they, in terms of are they able to recover some of the debt, and in terms of expectations, they really need to see that the banks are going to be able to return a dividend, and forecast for growth and revenue needs to be positive for them. And we've seen that US banks have come under pressure in the first quarter this year with speculation by investors that they're not going to be able to do that.
Could JP Morgan, as an international bank, be seen as a leading indicator perhaps for how our South African banks are going to be performing going forward?
We expect so. It's definitely one of those banks that definitely sets the tone, and our local banks have felt the pressure of the underperformance of international banks, the US banks, and so really, it could set a tone. Our banks have recovered from March lows. Our banks, however, don't have similar risks, but definitely we could see a bit of a turnaround if those numbers out of JP Morgan are worse than expected.
Well, we saw a bit of a recovery in our banks last week. We had Standard Bank up to 105 Rand again. It's pulled back a little bit since then. If we do see our banks pull back further after those JP Morgan numbers, would that perhaps be a buying opportunity, say for Standard Bank at below 100 Rand?
Correct, Stephen. Standard Bank has come out and they have a really clean house. They've retrenched, they've lowered sponsorships, so they have really done a lot, and they've made it very public as to what they have been doing, selling off assets. So really, below 100 Rand, it is a very good buy. We found support below 100, so it would be a good buy at those levels.
For Strand, that's a bank that you normally like, trading around the 20 Rand mark, offering value for investors, do you think?
First Rand, we saw it reach the low of 18 Rand 28 early in March. First Rand has been a bank that has returned. They had excellent financial results we saw early in the year. So below 20 Rand, always a good buy, Stephen.